To the show, Total Financial Solutions, Safer Money Hour. Arif Halaby along with Jeff Gerard, right next to me on your place for news, talk, and information. We're here every week at this time, talking about your family's finances, getting out of debt, of course, managing money, planning for your future and your retirement. So what is it all about when you try to get out of debt and manage your life and plan for the future? You've heard us talk about retirement and student loans all in the same breath. Well, what does that mean, and why would we ever even do that? What do they have to do with each other? Well, because right around the time when you're getting serious about retiring, coming to a date or start talking about some retirement plans, it's right about the time that your last one, or maybe your first one, is going to college, and you start thinking, my goodness, how are we going to come up with 50, 100, maybe more, $200,000 in total expenses for college and expense? So they do go hand in hand, because often the dollar can only go in one place, right? If you put $1 in retirement accounts, they can't go over here to college, and if you're paying for somebody's college, you can't go over here for retirement. So those dollars can only go in one place at a time, and that affects what you're going to do and what you're going to, how you're going to live and the lifestyle. So we want to get into some things that you need to know about some year-end retirement strategies, but at the same time, we're going to kind of mix in some options, if you will, for college. We're going to cover that in the second hour as well, so you and your family can get to the right place, which is financial freedom for you.
I think a big deal to keep in mind is, some of these deadlines, and people think retirement planning, it's kind of this open source game where you can just put money in, hopefully get a deduction, not pay tax on that money, and then, take it out in retirement. Well, while that's true conceptually, there are some deadlines you have to consider, and year end is a great time. And I don't mean, December 27th. I mean, October, November. These are the times where you should really be seriously considering what your strategies are for saving for retirement. Because, look, there's no wrong way to save, but I think there are some more efficient ways than others to save. You can save without getting a tax break. You can save while getting a tax break. So at the end of the day, the real goal here is to put money aside for you and your family's retirement. So doing it a couple of different ways, considering some different ways, that's kind of the challenge that some people have is finding, I guess, that quote unquote the right way. So we're going to give you some tips, I think, that can help before the year end and kind of demystify some of that, because a lot of people just get on that treadmill, or if you know this, they go to work, they have a workplace retirement plan, they're putting money in, I don't know, maybe they don't even know how much they're putting in, they haven't looked at their paycheck in, gosh, how long?
Yeah, or even what the matching is. The matching formula that your company has with your particular retirement account should be almost like your cholesterol or your Social Security number. You should know those numbers front and back. And sure. I know a lot of us go, well, I just don't want to be bothered, and it's just a pain in the tush. And I get all of that, but at the end, you still have to come up with a plan so that your family knows what those numbers are, and you're not in a position to guess, because when the time goes by, when the clock ticks, it's over. You don't really get a second chance to come back and try to figure out if you've done it correctly or not. So there's part of that formula that we're looking at. There are some end-of-year things that you can do. So in the retirement world, start with a review, kind of an update. You can use the holidays, both Thanksgiving and Christmas holiday, as a time when you're home. You didn't plan on being home. It's not a normal Tuesday or Friday. And you can sit there and say, let's maybe clean up around the house. Let's clean that closet. Maybe we'll do some work around the garage or something. But in addition to that, let's clean up our finances. Let's get our arms around what our balances are in some of our accounts, what our fees are in some of our accounts, whether we should change our checking account or our savings account away from the credit union or to a new credit union or away from the bank, right? All of those things are part of the formula, so that what you're doing is setting up a time to say, this makes sense for us in doing what we're doing. Now, where does that drop into play? Number one, take a look at your insurances. Jeff, we've looked time and again at what we're spending in auto insurance. Today, that's a commodity. You see it on the commercials on TV. They have characters, whether they're lizards or waitresses and people that look all funny, and their job is to try to sell us car insurance or homeowners insurance. It seems to be a commodity. However, that means that people are very price sensitive, maybe less service oriented, but more price sensitive, and so we can compete in that world.
We sure can, and a part of this is taking a look at the relationship you have or may not have with your auto or homeowner's insurance carrier, because a lot of times we've seen when someone comes in and we review their insurance, they've been with a particular carrier or a particular company for a very long time. And it's just kind of because they just have. Well, what do you like about this company? Well, I've known the agent for a long time. Or, my dad was with, or my mom was with, and, there's a backstory to it a lot of times. But maybe they are not taking advantage of some of the savings that could potentially be out there. Sometimes we've seen that very case that I just illustrated, and they have different carriers for their home or for their auto. And when little did they know, they could have saved an enormous amount of money over time by bundling them with the same company.
Yeah, so, it's the old out of sight, out of mind, right?
That's
You're
right.
just not paying attention to it.
That's right. So a big part of that is to use this time, like Arif's saying, to review it, to see, are you leaving money on the table somewhere? Is there something that you're paying extra for that you don't have to? Because like he said, this is a commodity. Carriers are out there competing for your business, and they will do that. The way they talk to us is through premium, right? If they really want a lot of people to sign up under their program, they'll lower the prices. And if they don't want you, then they don't say no necessarily. They just make the price not affordable to most people.
It's the same as in life insurance, right? Because you're sitting down in the life insurance world. If companies want you, if you're a male, 45 years old, great health, companies say we're low on inventory. In the life insurance world, your life is an inventory to a life insurance company. So they lower the premiums to drive in the more business so that more 45-year-olds come in and get life insurance, male 45-year-olds between this age or this health status. Once they reach their numbers, maybe it's maybe they need another 10,000 or 500, whatever the number is. Once they say we have enough of those people coming in, then they'll say, okay, raise the prices back up. It might take 2 years. It may take 5 years. Doesn't normally shift on a dime. And so by lowering those rates and bringing in those lives, because people pass away, they cancel policies, etc., they drive direction in and out of a company. And the way that insurance works, regardless of the type of insurance policy, works in the law of large numbers, meaning you need a lot of people, and statistically speaking, companies can kind of guess how many of those are going to use the services or require, something. And now they end up saying, let's cancel or let's raise the prices of those males between those ages, and let's go off in the other direction,
Well, and in that same vein, we're talking about auto and homeowners. Let's say there was a company that insured an area that just maybe they had a lot of insurance and they were heavy in an area that just had a fire, right? Or some damage from landslides. I mean, you name it. That company, in our industry, they say it's called taking rate, where in fact, even if you were in an area where you didn't have any type of peril, no damage was done to your home, or even in a place where there were a lot of auto accidents. I mean, you've seen disasters and heavy rains, so you can kind of imagine that as things seasonally happen, what does this all mean to you? It means this, that even if you didn't get into a car accident last year or your house didn't burn down 3 years ago, the company that's insuring you might be charging you more in premiums just based on the sheer fact that they're trying to recapture some of their losses. So that happens from time to time. Why does that even matter to you? Because you may not know that your company has been slowly and steadily increasing you 5, 6, 7, 8% a year in your insurance premiums on the auto or the home side. So that's money that could be in your pocket had you shopped around a little bit. I know it's going to kind of hurt. It's a little bit of a culture shock. You don't get to call the same, person that has a local number that you could go drive by their office, a little brick and mortar shop maybe, or maybe they come by your house for a holiday because they're that close to you. But thinking in the sense of, hey, I can still have that great relationship with that person and they don't have to service my insurance. So it's really at the end of the day what you can put back in your pocket, because what you don't spend can go towards savings, and that's kind of the goal here and how this ties into retirement. And
here's part of this is any dollars that go out in the form of auto insurance or homeowners insurance or life insurance premiums, you don't have to, you can use those to pay down debt, you can use those to pass on for college savings, etc. The primary part of this insurance review at the end of the year is that it's a good moment in time to take stock and to take a look. Now, I know you might be saying, but I just paid my auto insurance last month or 4 months ago, and it's an annual policy, so I'll check in with it in a year from now. I promise I'm going to remember. What happens, Jeff?
Well, you're going to be just overpaying for the next year potentially if you found somebody that's lower. And really what you have to take a look at is this. If you made a payment to your auto insurance on an annual basis, you're probably going to want to keep it at least for the first 3 months, because they have something called earned premium, where you're not going to be able to recoup that, and you'll basically lose a quarter of what you paid if you canceled now. But why does it matter? Because if over the long haul you're starting to see a significant amount of savings, think of what the difference is. It's like leaving a CD, and paying a small penalty to make, an enormous, amount of return somewhere else.
So even if I've paid in advance, Jeff, for the whole year,
you'll get a refund, basically.
Yeah, it's almost a prorated.
Right. There you go. Yeah, that's kind of what you're getting at there. So you could, even if you're midterm, I think that's probably a good time. Last month may not be the key, but again, you have to take a look at it. Certainly 3 months or past into that year policy, you can certainly look at a refund and really take a look at the difference. Are you going to save money over time? And that's really the key there.
So here's what I want you to focus on is the end of year insurance review is to look at your auto insurance, especially if something has changed since you first started with this company. For example, you now have a teenage driver, or the teenage driver has left your policy. So maybe when you started, you did have 2 teenage drivers, and now both of those are out of the house. But you say, oh, I've taken them off my insurance. Yeah, but is it the same company? Because some companies specialize in having teenage drivers. Some punish you for having teenage drivers.
That's
so
right.
You're going to want to look, did you have an elderly person move in the house with you, and now they're excluded, or they're now added to your policy, etc. So all of these things, any changes, a new car, well, yeah, we added a new car, it's on our new policy. Yeah, but have you checked to see if that third automobile, right? Like some of us guys, we do our midlife crisis, the red, I passed one today, driving to work. It's a red convertible Corvette. Just a beautiful, beautiful car. And you think, well, that is just hilarious to look at that and go, let me pull up next to it, and it is a middle-aged guy. I don't know. We have something that's middle-aged guys, because now I'm one of them. And we look at that and we say, well, maybe the insurance policy that you have, or the company that you have, doesn't specialize in that as a separate car. Maybe you should get a broker to take a look at your policies, and maybe it makes sense for maybe the classic car. Maybe you just got the classic car. Maybe it's that fancy 56 Bel Air or something, and you move that off into its own policy.
Right.
And then the other insurance is with another company. So sometimes you need to shop that if anything has happened since you started with this company. Okay, that's one. Second is life insurance. Now look, as we get older, life insurance costs more money. However, you may be coming towards the end of your time. Maybe it's a 20-year policy or a 30-year policy, and you're more than halfway done. Maybe it's time to take a look and get another 20 years or add another 30 years to it to get you through retirement, through the back end of your life, so that the policy doesn't run out. That's a term insurance. There are some pros and cons to that. You can check with us. That's what we do. You can check with your financial guy, gal, your broker, insurance broker. This is a little bit of I know some of my friends in the insurance world aren't going to like this, but be very careful when you combine the same person doing your auto, your home. That's fine. That's kind of one specialty. But your life, your long-term care, well, those are starting to be different specialties. Your health insurance, they also handle my dog, pet insurance. Well, after a bit, nobody can be that good at all of those things. So basically learn about separating that up a little bit. Getting a specialist in each one of those areas and having them talk to each other and work together is going to be our next step here before we take a break, and that is coordinating with your financial experts.
I want to add to something you just said a minute ago, Arif, is it may not even be a comment on the agent themselves being good or great at a bunch of different areas. The companies they represent is a key factor here. And you mentioned the word broker. I like that because that's someone that, generally speaking, can go out to a multitude of companies and basically do the shopping for you. But if they are what's called a captive agent, or they represent one company, then that company might be fantastic at auto and home in this example, but they might not be as competitive on the life side or any of those other products that kind of get away from that vein of now insuring people or taking care of lives versus stuff, if you catch my drift. So that's really the key there.
And there's a way to break those into certain specialties. Certainly some offices may have internal people that are good at it, but you don't want somebody doing two things that are night and day, two different things. Like my brain surgeon is probably not going to be the best landscape architect. Probably not. Could be. But I wouldn't say that pool man or woman or the person who takes care of your pool is probably also the best person to water your plants. They both use water. Yeah, one has chlorine. We'll be back in just a minute. Total Financial Solutions, Safer Money Hour. Arif, Halaby, and Jeff Gerard on AM 1220 KHTS.